How credit score work in US. 7 simple ways to build better credit. Have you ever applied for a credit card, an apartment, or a loan and heard the term credit score? You probably know that a higher credit score can be helpful. But what exactly is a credit score? How is it calculated? And more importantly, what can you do to build a stronger credit history? In the United States, your credit history can play an important role in many financial decisions. That is why understanding the basic can be a valuable financial skill. In this video, we will explain what a credit score is, what factors can affect it, a common mistake to avoid, and 7 practical habits that may help you build a stronger credit profile over time. This video is for general education purpose only. It is not personalized financial or credit advice. So let's get started. What is a credit score? A credit score is a number that is calculated from information in your credit history. Different scoring models can use different methods, so there is not always just one single credit score. You may hear about FICO, a score, and vintage score. For example, the exact score can depend on the scoring model and the information being used. So instead of thinking of your credit score as a permanent number, think of it as a snapshot based on your credit information at a particular time. Why does credit matter? Credit can matter when you apply for certain financial products or services. For example, lenders may consider credit information when evaluating applications. Credit history may also matter in other situations depending on the company, state, and type of transaction. A strong credit profile does not guarantee approval, but understanding your credit can help you make more informed financial decisions. The first important factor, payment history. One of the most important things in credit scoring is your payment history. In simple terms, it looks at whether you have made your credit payment as agreed. This is why paying attention to due dates matters. A missed or late payment can potentially have a negative effect on your credit profile, especially if it is reported to the credit bureaus. A simple habit can help. Know your due dates, set up reminders, and where appropriate, consider automatic payments for at least the required amount so you do not accidentally forget. Just make sure you have enough money available in your account. The second factor, credit utilization. Now let's talk about credit utilization. The refers to how much of your available revolving credit you are using. For example, suppose a credit card has a $5,000 credit limit. If the reported balance is $2,500, that is 50% utilization for that card at the time. People often hear advice about keeping utilization low, However, there is no magic number that guarantee a specific credit score. Credit utilization can change as your balances and credit limits change. The important lesson is to avoid treating your available credit as extra income. A 5,000 credit limit does not mean you have $5,000 of free money. It means you have access to a certain amount of credit under the terms of your account. The third factor, length of credit history. Another part of your credit profile is the age and history of your accounts. In general, a longer credit history can provide more information about your borrowing behavior. This is one reason why closing an older account can sometimes have unintended effects depending on the situation. You should not keep an account open simply because someone online says it will increase your score. Look at the fees, terms, usage, and your overall financial situation. The fourth factor, new credit. Opening several new credit accounts in a short period can affect your credit profile. When you apply for certain types of credit, a hard inquiry may be added to your credit report. That does not mean every credit application is bad, but applying for many accounts without a clear reason may not be a good habit. Before applying, understand why you need the account and review its terms and cost. The fifth factor, credit mix. You may also hear about credit mix. This refers to the different types of credit accounts in your credit profile. For example, revolving credit and installment loans are different types of credit. But here is an important point. You do not need to take out loans just to create a different credit mix. Never borrow money you do not need simply to try to improve your credit score. Your financial decisions should be based on real needs and your ability to manage the account responsibly. Tip number 1, pay on time. This is one of the simplest habits to build. Know when your payments are due. Use calendar reminders, set alerts, and review your statement regularly. One missed date can create unnecessary financial stress. A good credit strategy starts with good payments habits. Tip number 2, keep your spending under control. Your credit card should support your payment system, not replace your budget. If you spend more than you can comfortably repay, the interest and fees can create financial pressure. Before making a purchase, ask yourself, could I afford this purchase without depending on future income? The question can help you think beyond the credit limit. Tip number 3, check your credit reports. Reviewing your credit reports can help you understand what information is being reported. It can also help you spot potential errors or information you do not recognize. If you find something incorrect, you can review the appropriate dispute process through the credit reporting agency or relevant source. Checking your credit information should be a normal part of financial awareness. Tip number 4, be careful with fees. A credit product can have different fees depending on the account. They may include annual fees, late fees, balance transfer fees, cash advance fees, or other charges. Do not focus only on rewards or promotional offers. Read the terms. Understand the cost. A reward is not automatically valuable if you are paying significant fees or interest to get it. Tip number 5. Avoid maxing out your available credit. Using nearly all of your available credit can increase your utilization and may put financial pressure on you. More importantly, it can make it harder to handle an unexpected expense. Your credit limit should not become your spending target. A healthy financial plan starts with what you can afford, not what you are allowed to borrow. Tip number 6. Be careful with co-signing. Co-signing a loan or credit account can create financial responsibility for you. You may trust a friend or family member completely, but if the other person does not make the required payments, that could still create financial consequences for you. Before co-signing anything, understand the risk and responsibility involved. Never agree to financial responsibility simply because you feel pressured. Tip number 7. Be patient. This may be the most important tip. Building credit is usually not an overnight process. There is no reliable shortcut that can instantly create a strong credit history. Consistent financial habits matter. Paying attention to payments, managing credit responsibly, reviewing your credit information, and avoiding unnecessary debt can all be part of a long-term approach. A simple example. Let's imagine a college graduate who has just started working. They get their first credit card with a $2,000 limit. Instead of treating it like extra income, they use it for a few planned expenses. They track their spending. They pay their statement as required. They avoid unnecessary purchase and they review their account regularly. Over time, they are building financial habits and creating a track record of managing credit. The exact credit score they eventually receive will depend on many factors and the scoring model used. The important point is the behavior. Common credit mistakes. One common mistake is making payment late. Another is spending up to the credit limit simply because the bank approved it. Another is applying for multiple accounts without understanding why. Another is ignoring a statement for credit reports. And one of the biggest mistake is believing every credit tip you see on social media. Credit rules, scoring models, financial products, and consumer regulation can change. When something matters to your financial situation, check reliable source and read the actual terms. Final thoughts. A credit score is not a measure of your personal worth. It is simply one part of your financial profile. Understanding how credit works can help you make more informed decisions. Start with the basics. Pay attention to your due dates. Keep spending under control. Understand your credit utilization. Review your credit reports. Be careful with fees. Avoid unnecessary debt and give your credit history time to develop. You do not need a perfect credit score to build good financial habit. What matters most is understanding your financial responsibility and managing them consistently. So thanks for watching. If you found this video helpful, subscribe for more simple and practical personal finance educational video. And remember, don't chase a number, Build good financial habits first.